Okay, let's talk about risks and uncertainties. Okay, you see, mostly what happens is that if you are going to appraise a project, if you want to undertake a particular investment, okay, you can see the question that we solve, everything that we do, we don't take into consideration risks. But if you want to undertake a project, you want to buy a car, the first thing that you have to think about the project is that will something happen to the car? Will this particular business be there forever? What are the things that is going to affect that? In the investment appraisal, in reality, we don't take those things into consideration. What we do is that we just do forecast of whatever amount that we are projecting, and we assume that everything is going to be fixed as estimated or as expected. But in actual sense, that will not happen. In real practice, that will not happen. You see that the question that we just looked at, they are saying that the demand for the first year will be 1.4 million. That is for a full year. Something can happen and demand will increase. What if the demand increases? What will happen? Okay. Right now, we are saying that we are going to sell 1.4, but we are going to sell this to maybe 3 categories of people. The children, the youth, and also the grown-ups. Okay. We are saying that these people are going to buy this. Okay, are you sure? What is the percentage of those people buying this? And what is the percentage of these people buying this? And what is the percentage of these people buying this? So all things being equal, if the percentage should work, then what will be our total demand that we'll be getting from these people? So the risk has to do with you having information about how the thing is going to happen. It can go against you. It can also go in your favor. So if you talk about risks, you have the probabilities about what is going to happen. You have chances about what is going to happen. You have certain information about what is going to happen. But if you count what we talk about uncertainties, you don't know what is going to happen. You don't have any information, any control over what is going to happen. So under investment appraisal, the demand can increase, but you don't know, because that is why you are saying that the demand will be 1.4 a year in the first year. The demand can increase, you don't know. So you don't know what is going to happen to the demand. You don't know what is going to happen to the selling price. The selling price can fall. The variable cost can fall. The fixed cost can increase. If that happens, what will be the effect on your NPV, or what is going to be the effect on the investment, on the cash flow of the investment? Okay, things that you don't have control over, or things that you are not certain, you don't know what is going to come out of it, is what we call the uncertainties. And under the uncertainties, we use what we call sensitivity analysis. Sensitivity analysis. So we use under the uncertainty, we use what we call sensitivity analysis, which is what if analysis. Sensitivity analysis, which we call the what if analysis. The what if has to do with what if this thing happened? What if that thing happened? What if this thing happened? Okay. Under the risks, we use expected values, which we use probabilities. Under expected values. So those who are doing MA, you can see that we have used probability to find variable costs and other things the last time. So you'll be giving probabilities that, okay, it is probable that this number of people is going to purchase this. So if that happens,
Amen.
Okay, so sometimes they will give you probabilities that, okay, it is probable that 20% of these people will buy this. If that happens, how many quantities are they going to buy? 50% will buy this. If they actually buy, how many quantities are they going to buy? And the remaining 30%, they will buy this. So what we do is that we find the probability on the quantity and now add it to get the expected what? Demand, or the expected values. The expected value. So that is about the probability. But the sensitivity analysis is very simple. What we do is that for any variable, we do the sensitivity analysis on all the variables. We can do it on the sales volume, which is the same as the contribution. Okay, they will say sales volume. Sales volume is the same as the contribution. Okay, they can also ask you to do it on the selling price. The selling price is the revenue. They can also ask you to do it on the variable cost or the initial investment. They can also ask you to do it on the useful life or the discount rate. So sensitivity analysis is calculated like this. Sensitivity analysis for any variable. Sensitivity analysis for any variable is calculated as the NPV of the project divided by the NPV of the variable under consideration. So the question will tell you the variable, then you multiply by 100. You multiply by 100. So if they ask you that, okay, first you have to calculate the NPV of the project first. First you have to calculate the NPV of the project. And the variable that they are asking you to do the sensitivity analysis on, you also have to calculate the NPV of that particular variable. You have to calculate the NPV of that particular variable. All the calculations for variable cost, calculation for variable cost, selling price, sensitivity analysis, the sales volume is the same as the contribution, and the initial investment, the fixed cost, all follow the same calculation. NPV of the project divided by the NPV of the variable that they're asking you to calculate. But if you come to the sensitivity of the discount rate, is calculated as the internal rate of return minus the discount rate or the factor divided by the discount factor times 100. Okay. Sometimes they can also ask you to do it for the useful life. The useful life is calculated as the discounted payback period, the useful life of the project, the initial useful life minus the discounted payback period. Discounted payback period divided by the initial useful life times 100. Okay, so for the discount rate and the useful life, their calculation is different. But apart from this, and the question will always ask you for the sales volume, the initial investment, contribution, and those ones, they always ask you for that one. And March 2023 in MA, they brought a question on sensitivity analysis. And most of the students who are not doing FM are just there because they don't know what is sensitivity analysis. So basically, this is how we do the sensitivity analysis, which is sensitivity analysis has to do with the uncertainties. We don't know what is going to happen. We don't have any information about what is going to happen. We can just be there and demand will increase. We are not expecting it. But if you come to risks, we have certain information about that. So we use what we call expected values. Expected values. Okay. So that is all about the sensitivity analysis and the expected values. So we are going to pick one question to deal with that. Then we move on to another issue, which is lease or buy. Lease or buy. Let's look at question number 13. Okay, let me share the question so that the MA people can also see it because they don't have it. Auntie Eunice, read question number 13 for us.
Question 13. Okay. Humanat Co. is considering investing 50,000 in a new machine with an expected life of 5 years. The machine will have no scrap value at the end of 5 years. It is expected that 20,000 units will be sold each year at a selling price of 3 cedis per unit. Variable production costs are expected to be 1.65 per unit, while incremental fixed costs, mainly the wages of maintenance engineer, are expected to be 10,000 per year. Humanat Co. uses a discount rate of 12% for investment appraisal purpose. and expect investment project to recover their initial investment within 2 years. Required. Explain why risk and uncertainty should be considered in investment appraisal process. Calculate and comment on the payback period of the project. Evaluate the sensitivity of the project's net present value to change in the following project variables: that sales volume, sales price, variable cost, and discuss the use of sensitivity analysis as a way of evaluating project risk. Upon further investigation, it is found that there is a significant chance that the expected sale volume of 20,000 units per year will not be achieved. The sales manager of Luminat Co. suggests that sales volume could depend on expected economic states that could be assigned the following probabilities: economic states, probability, annual sales volume is stated below. So calculate and comment on the expected net present value of the project.
Okay. The sensitivity analysis question, it will not be plenty question. If you like, you can go to March 2023 MA question, the question number 4. It will be very simple question. The statement will not be plenty. It's a very simple question, unless they want to waste your time. That's why they will give you plenty things, or they will give you plenty intro, which after you are done reading it, maybe 3 minutes is gone or 2 minutes is gone. All right. So the company is considering investing 50,000 in a new machine with an expected life of 5 years. The machine will have no scrap value at the end of 5 years. It is expected that 20,000 units will be sold each year at a selling price of 3 cedis per unit. Variable costs are expected to be 1.65 per unit, while incremental costs, mainly the wages of maintenance engineer, are expected to be 10,000 per year. Unimat Co. uses a discount rate of 12% for investment appraisal purposes and expect investment project to recover their initial investment within 2 years. Okay, that is what they are asking you about the payback period. Okay, what you are going to do is that they can also give you a lending question where they will give you the capital allowance, they will give you everything. So you have to calculate your net present value in the way that we calculate the net present value. The first thing for sensitivity analysis, the first thing that you have to do is to know the net present value of the project. So we have to find the NPV of the project first. That is the most important thing. Find the NPV of the project first. After you find the NPV of the project, then you now find the NPV of the variable that they are asking you. So after finding the NPV of the project, you will get the NPV of the selling price, the NPV of the sales volume, the NPV of the variable cost. But what I'm going to do over here is that they ask for only 3. I'll add the initial cost and I'll also add the phase cost to it. Okay, so the first thing that we have to do is we have to find the NPV of this particular project. Let's find the NPV. Let's find the NPV of this particular project. Okay, let's find the NPV of this particular project. Let's find the NPV of this particular project. Okay. All right. What we do is that we need to prepare the cash flow statement. Okay, because they haven't given us a cash flow straightforward. So if you want to prepare the cash flow statement, what you do is that go and do small workings for. You can see that the unit will be constant every year, isn't it? The unit is 20,000 every year. The unit that will be sold is 20,000 every year. The unit that will be sold is 20,000 every year. Since the MA people they don't have the question, I'll be using the the question. I'll be bringing the question at the same time. I'll be bringing the solution this one. So you can see that it is expected that 20,000 units will be sold each year at a selling price of what? So every year, the company will be selling what? 20,000. And the selling price will be the same. So it means that what will be the selling price for every year? What is the selling price for every year? Or what is the revenue? What will be the total revenue for every year?
60,000.
20,000 by 3.
So 60, that will be 20,000 times 3. That will be 60,000 every year, isn't it? Okay. Since we'll be getting 60,000 every year, this can be called what?
Selling.
Is what?
Sales volume.
This form, you people have to know that I don't ask questions that I think you know the answer, or the questions that you can just stand up and answer. I don't ask cheap questions. So whenever you want to, whether the answer that you are thinking about is the correct one, but ask yourself, is this answer cheap? If it is cheap, don't say it. We are getting 60,000.
Okay.
This form of cash flow.
Please, is it annuity?
Annuity. So this is an annuity. We are getting 60,000 every year. This is an annuity. So we can use annuity factor to what? To discount it. Okay. Come to the variable cost. What will be the variable cost? What will be the total variable cost? The variable cost per unit is 1.6. So we are selling 20,000 units every year.
33,000.
Okay, this 33,000 will be for year 1, year 2. It will be fixed for 5 years. So that is also annuity. You can discount it. You can say that the fixed cost is also what? Fixed. It will be 10,000 every year. So you can also use annuity for 5 years to discount that. So the first thing that you have to do is you have to find the total revenue for each year. Total revenue for each year. Okay. You have to find the total revenue for each year. So you can do small working somewhere. So you have your years here, because this is not plenty. So you can have the years there. Then you can have your cash flow. You can have your discount factor. Then you have your NPV. The discount factor is 12%. So we can have our currency sign here and our currency sign here. So we have year 0. Then let's find okay. So because we are going to, let me do the workings here. Okay. So the workings will be revenue or annual revenue. Annual revenue will be 3 times what? 20,000 units. That will give us what? 60,000. Are we okay? Okay. Let's come to
Yes.
cost. So our cost, our variable cost for every year will be what? 1.65 times what? 20,000. I'll
Time.
get 33,000. What will be the contribution?
$27,000.
Then I will now have my fixed cost. So the fixed cost will now be what? 10,000, isn't it? So this will be my cash flow. So to find the NPV, you now bring your cash flow. The cash flow, the year 0 will always be the initial investment. How much are we spending to buy this particular? How much are we spending to acquire the machine?
50,000.
50,000. So the discount factor will be 1.00. Then we now have, because we are paying, it's an outflow. So year 1 to 5, what will be the cash flow? What cash flow are we going to use? The cash flow is the 17,000. So year 1 to year 5, 17,000. So you now find your annuity, 12 years. Annuity for 5 years at 12%. What are you getting?
Um, 5 years annuity to 3.605.
3.605. If you multiply, what are we getting?
Times 17,000. You have 61,285.
Okay. So what will be our NPV?
NPV will be just take 5 from this. You get 11, 12. Okay, that's 5.
This is not part of the question. But without the NPV, we can't find
Sir,
that.
please.
Yeah.
Sir, please. How did you get the 17,000, please, sir? I thought it was 20,000.
I hope you can see.
Yes, sir.
Okay.
Sir, you are multiplying 20,000 by 3.
That's the revenue. The variable cost is 1.65 per unit. So if I multiply, I'm getting 33,000. So my contribution will be 27,000. And the fixed cost per annum is 10,000. So my cash flow will be 17,000 for
Yes, sir.
every year.
Yes, sir. Thank you, sir.
Okay. All right. Okay. So the question can ask you to find the NPV. Okay. The question asks you to find the NPV. Just find what they are going to give to you is that since the focus is not NPV, the focus is how to calculate the sensitivity analysis. So they will not bother you with the NPV. They will give you the unit to be per annum, and the selling price, they will give you a fixed value for a year. But if you're not giving a fixed value, you use each unit or each year's unit, each year's selling price to do the normal way. So year 1, if the selling price is different, a unit is different, you multiply to get a revenue for year 1. Then you get a cash flow for year 1 and use that as a cash flow for year 1. If year 2 is different, you also do that and get a cash flow for what? The year 2. The cash flow is your revenue minus any relevant cost, variable cost, and then the fixed cost. If you have any tax benefit, if you have anything, the way we calculate the cash flow before we discount, that is how we are going to do over here. So the calculation of the cash flow is the revenue minus the variable cost, minus the fixed cost, plus any opportunity cost, any scrap value. If we should have a scrap value, the scrap value will come in what? Year 5 as a cash flow, but we don't have any scrap value. The question is saying that there will not be any scrap value. So this is not different from how we do the calculation for NPV or cash flow. Okay, but the focus is not on the NPV, but you can't calculate the sensitivity analysis without the NPV. So sensitivity analysis is calculated as the NPV of the project divided by the NPV of the variables. The question will ask you all multiplied by 100. Okay, if you are looking for cost, this is how we do. But if they ask you for discount rate and the useful life, they are different. We do different things. Okay, let's now come here. Okay, they say explain why risks and uncertainty should be considered in the investment appraisal process. Okay, the risks and uncertainty give us a clear vision about the expected returns of what? The investment. It helps us to be aware of things that might happen. So the risks and uncertainty create some kind of awareness about what? Things that the things that we are not expecting but might happen. So we'll be aware of, okay, this thing, though we don't have information about it, but it is likely that it might happen. So this one gives us a clear understanding. It gives us a clear understanding and a clear picture about the returns that we are going to get from the project. It tells us more things that we can't see. Help us to get or open our eyes to what? things that we are not expecting, and we should also prepare for that. It helps us to prepare for the unthinkables. Okay, let me put it unthinkables. Okay, calculate and comment on the payback period of the project. Calculate and comment on the payback of the project. So let's calculate the payback period of this project. The payback period that they are talking about over here, since they didn't say discounted, assume that it is normal what? Payback period. How do we calculate payback period? Payback period is calculated as the cash flow, the year's cash flow, then we have balance here. So the year's 0, we have 50,000, then we have 50,000. Okay, the first year, our cash flow will be 17,000. It is a normal cash flow. It is a normal cash flow. But I want to tell you something. You see, instead of you doing these two, 17,000, and this will give us 33,000, then this will now give us 16,000. Year 3, 17,000. It will give us 1,000. Okay. You see, this is how you calculate the cash flow. Okay. Then our payback period will be calculated as a prior year to the payback, which is 2 years, plus the 16,000 divided by 17,000. Then you can see multiply by 1 or 12 if you are doing it in years. So multiply by 1 year. What are we getting? What are you going to get there? How many years are you going to get there? 16,000 divided by 17,000 times 1. Do it on a yearly basis. So multiply by 1. I'm getting 2.94 years. Is that correct?
Yes, it's correct.
Okay. But you know something? Last time I was telling you that if the cash flow is even, if the cash flow is constant, what you can do is that your payback period is calculated as the initial investment divided by the annual cash flow. So your 50,000 divided by this, you have to get 2.94 years. So if your cash flow is constant, your payback period is calculated as the initial investment over the annual cash flow, which is 17,000. Are we getting 2.94 for that?
It's correct.
Okay. Let's come to the main issue. My focus is not about NPV. My focus is not about payback period. My focus is about how to calculate what? Sensitivity analysis of a project. How to do the sensitivity analysis or how to do computation for it. Okay. The question is asking you to do what? The sensitivity analysis for the sales volume. The sales volume is the contribution. The sales volume is the contribution. You can see that our contribution is what? 27,000. But we're not going to take the 27,000. We are going to find the present value of the what? The 27,000. This 27,000 will be for 5 years. Every year, 27 for 5 years. So we have to present value it to today. So we multiply this by the annuity factor. But don't worry, we'll get to that place. The first thing that I want us to do the sensitivity analysis for is the initial investments. They didn't ask us, but let's do it for the initial investment. Okay. So we are saying that sensitivity analysis or sensitivity is calculated as the NPV of the project. The NPV of the project, which is 11285. So 11285 over the NPV of the variable. The variable in question here is what? What variable are we considering here?
So the initial investment.
Initial investment. So the question is, what is the present value of the initial investment? What is the present value of the initial investment? What is the present value of the initial investment?
So the same amount though.
I'm asking
50,000.
question. I'm asking question. You're also asking question.
Sorry. So I think it's 50,000 because
You are not answering my
the
question.
initial
You think
investment.
It's the 50,000 times the discount factor for the first year.
you are not serious. Robert, you are not serious. You see, what is the present value of the initial? What is the today's value of the initial investment?
So that's what I'm saying. You find the discount factor for the first year multiplied by the initial investment.
The discount factor for the first year. You are not going to buy the thing at the end of the year. You are going to buy the thing today. So how much are you? What is the today's value of what you are going to buy? If you are going to buy something in a year time, that's what they will ask you, what is the today's value? Then you discount it by the what? The first year annuity. You are going to buy the thing today. So the price of the thing is the price today. The initial value is the same as the value of the thing. The today's value is the 50,000. But the person who is saying that he's thinking, I don't want him to think. I want him to say it. The initial investment, the present value of the initial investment will always be the same amount, because that is the amount that we are going to use today to purchase the machine. The machine will not be purchased in a year time. If the machine is going to be purchased in a year time, then we find that today's value from a year to today. That's why we use the discount factor for the first year. The discount factor for the first year can never be 1.00. And that is why we always multiply the initial investment by 1.00, because the present value of the decision, or the present value of what we are going to buy, is the same as the amount, because we are going there to buy the thing today. As soon as we want to start a project, we go there and buy, and that is today. Divided by 50,000 times 100. What are you getting?
$22.57.
Is it?
22.57.
22.57. Okay. $22.57. Okay. The thing is, for everything that you are going to calculate, you are going to comment on it. You are going to interpret it. Okay. Look at this. Look at this. What are we finding now? What are we finding? We are finding the proportion of what? The net present value of the initial investment. So the net present value forms what? 22.5% of what? The initial investment. Okay. The meaning is that if the initial investment increases by 22.57, or the net present value or the cash flow of the project falls by 22.57, the project is going to break even. Okay. Or if the initial investment increases by 22.57, the project is going to what? Break even. So if the initial investment increases by 5.27, it means that the initial investment will now be 61,285. Because if this increases by 22.57, it means that the increment will be the same as what? The NPV. So if the initial investment increases by 22.57, the project is going to break even. The project is going to have a zero return. That is the meaning. That is the interpretation. Everything that you're going to calculate, you have interpretation to that. Everything that you're going to calculate, you have to interpret it. Let me look at the second one. Okay, the second one is not here, but I will mention it. Let's do fixed cost before we count to whatever they are saying. Okay, so you have to find the NPV of the fixed cost first. So this will be the NPV of the project divided by the NPV of the fixed cost. Okay, the question is, for how many years are you going to incur this fixed cost? For how many years are you going to incur this fixed cost?
So every year,
Every year.
10,000
Okay,
for
every
5
year.
years.
Every year 10,000. So that will be for 5 years. So what we do is that we find a present value for the 5 years. We find a present value for the 5 years. The way we find a present value is very simple. Since we are using annuity, the NPV of the fixed cost is calculated as the annuity factor. We have gotten the annuity factor already, and that is 3.605. So 3.605 multiplied by the fixed cost. What will be the figure?
Five zero.
36050.
50.
So our sensitivity analysis for the fixed cost now will be 11285 divided by the present value of the 36050 multiplied by 100. What are we getting?
Very 1.3%.
31.
0.30.
Okay. 31.30. What is the interpretation of this? You have to, the NPV of the project forms 31.3% of the present value of the fixed cost. So what is the meaning of that?
A fall or increase in the fixed cost by 31.30 will cause the NPV to be 0 or break even.
If there is a fall in the fixed cost, the NPV will be increasing. So don't say a fall. If the fixed cost is reducing,
Reduced by 31.30.
the NPV will increase because the fixed cost will be subtracted from the what? The NPV. So if the fixed cost is lower, our cash flow will be increasing. So a fall will not be ideal. Okay, so it should be increased. Or if the NPV falls by 31.30, you can also say that if the NPV falls by 31.30, the project is going to break even, but this is not ideal. The best is remove the fall. Remove the fall in the NPV. Remove the fall in the fixed cost, but it should be a fall in the NPV or an increase in the NPV. An increase in the fixed cost, rather, not NPV. So we are seeing currently that our NPV forms 31.30% of our fixed cost. The meaning is that if the fixed cost should increase by 31.30, increase the fixed cost by 31.30 and see. Find 31.30 on the fixed cost and see. What are you getting? You are getting 11285, isn't it? Are we getting 11285?
Yeah.
Okay.
11285.
It means that if we add a 11285 to the fixed cost, we are going to be having what? A 0 NPV. A 0 NPV. So if the fixed cost increases by 31.30, the project is going to what? Break even. The project is going to break even. Or an increase more than 31.30 in the fixed cost will bring a negative what? NPV. So you can say if the fixed cost increase by 31.30, the project is going to break even. But the fixed cost increase more than 31.30, the project is going to give what? A negative what? Return, or the negative NPV. Okay, let's now come to the sales volume. Let's come to the sales volume. The sales volume is the same as contribution. sales volume is the same as contribution. Okay, the sales volume is the same as contribution. So the sales volume is the NPV over the NPV of the contribution. Okay, NPV of the contribution multiplied by 100. So let's go now. What is our contribution per annum? 27,000.
27,000.
So let's find the NPV of the contribution. NPV of the contribution will be 3.605 times 27,000. How much are we getting?
Nine seven three three five
97,335. So let's now find our sensitivity analysis on that. So sensitivity analysis will be 11285 divided by 97,335 times 100. What are we getting?
11.59.
11 point what?
59.
What is the interpretation of this? What is the interpretation of this?
Interpretation is if the sales volume falls by 11.59%, the project will record a negative NPV.
If it falls by 11.59.
11.59.
Okay.
And I also say,
Yeah, you said what? Someone is saying something. Can you also say what?
So, sir, if it increases by the 11.59%, then it means that the project will break even, right?
No. If it increases by 11.59, it will not break even. It will still bring a more positive return.
Okay, so sir, when will the project break even?
When the sales volume reduces by 11.59, that is where the project will break even. But anything above 11.59 will give us a negative NPV. Or if someone can also say if the sales volume reduces by 11.59, the project will give us a loss. Okay, they can also accept that one. The reason being that you see the contribution, we are here to subtract what? Fees cost from the contribution. We are here to subtract the fees cost from the contribution. We are here to subtract fees cost from the contribution. But if the sales volume or the contribution reduces, if the contribution reduces by 11.59, what will happen is that the contribution that we are going to be having will be the same as the fees cost. So in that case, your NPV will be 0. Your NPV will be 0. Okay, your NPV will be 0.
Please, can you repeat that sentence? The last sentence you just said. What to make the NPV 0?
That was the last thing that I had. So it's finished. So maybe if it is back, maybe I'll let you know. Are you okay? If it is back, I'll
No,
let you.
please, you are not okay. You
You
are
have
not
to,
okay. Please
you have to
repeat.
be, you have to be okay by force. You have to be okay by force. You get it? Because I'm the one in charge. So if I say you have to be okay, you have to be okay. You have to be okay and play along. Okay. So, yeah, Robert,
Sir,
you said I should do it.
so you said something making the NPV 0.
Okay.
I did not get the other part of, because we are analyzing whether deduction or increase, whether
Okay.
I did
So,
not get
so
that part.
let me show you the easiest way of doing the interpretation. Okay. You know what we're going to do? Okay. What is happening here? Our NPV is forming what? 11.59% of the sales volume, isn't it? Okay. And the sales volume, we say that is a contribution. So what you do is our current contribution is what? 27,000, isn't it? Our current contribution is 27,000. Am I correct?
Yeah.
Okay. What you do is reduce this contribution by this figure in C. Reduce this contribution by this figure, or you can make it 11.60. Reduce it and give me the new contribution now. Reduce it by 11.59 or 11.6 and give me the new figure. I'm getting 23,868. Is that correct?
Yeah.
Okay. So 23,868. Okay. This is a new contribution without anything. So we come and take our fixed cost from it. Our fixed cost is 10,000. So our new contribution now will be 13,868. What you do is that you now discount this using the annuity factor, multiply and see. You'll be getting something closer to 50,000. The difference might be due to the what? To the approximation. Are you getting something closer to 50,000? What are we getting?
I had 4,994.14.
Okay. 4,994.
4.14.
Which is 49,900 and something, isn't it? Okay.
Yes,
It's because of the approximation. We have approximated the 5,9 to the 6. That might be the issue. Okay. So you can see that if the contribution is reducing by 11.59, what is happening? You can see that the net present value will be the same as the initial investment, which is the 50,000, isn't it? So sometimes you can use the answer that you have gotten. You can also decide to increase the fixed cost by 31 by. You can also decide to increase the fixed cost that you have in the question by this amount and subtract it from the contribution and that present value to compare with what the initial investment that you have and see whether it will be negative or positive. Then you can now base on that particular information and interpret it. Okay, let's increase our fixed cost by 31.3. Let's increase our fixed cost by 31.3. The fixed cost is 10,000. I'm getting 13,130. Is that correct?
Yeah.
Okay. Our contribution is 27,000. So subtract the 13,130 from that and see. Then I'm getting 13,870. This is our new contribution multiplied by the discount factor 3.605. I'm getting 50,001. So that will tell you that if the fixed cost should increase by 31.30, the project will break even. Whatever you are going to calculate, if it is initial cost, say that if the initial cost should increase by 22.57, the project will break even. Or if the cash flows are to reduce by 22.57, the project will break even. If you come to fixed cost, the figure that you are going to get, if the fixed cost increase by that particular amount, the project will break even. If you come to the sales volume, if the contribution reduces by the percentage that you have gotten, the project will break even. But any increment above that particular figure, which is the 11.59, will give you a negative what? NPV. Or the company the project will make a loss. The project will make a loss. I don't know how you are going to go about it, but any figure you are going to take, if it is cost, if the figure that you are finding, if the variable that you are using is cost, if it has to do, if it is a cost, then it should be an increase. If the cost increase by that particular amount, the product will break even. But if it has to do with revenue, then that should be a fall. If the revenue falls, the project will break even. So the contribution is revenue. So if the contribution falls, the project will break even. If the initial investment increases, that is a cost. If the fixed cost increases, that is a cost. Are we okay? All right. Let's take the sales price. Let's take the sales price. The sales price is the same as the revenue. So the sales price is the same as the revenue. So the NPV divided by the NPV of the revenue times 100. So this one will do it straightforward. 11,285 divided by 20,000 times 3.605. So this is the present value of the revenue for 5 years. We do this for 5 years times 100. So what will be the down?
Sir, the 20,000 is the unit.
Is a unit.
So you know you.
Okay, sorry. So this will be 60,000. Sorry. Thank you. So 60,000 minus 3.605. I'm getting 216 times 100. What are we getting? What will be the percentage? What is the percentage?
10.30.
2 points.
10.30.
Okay. 10.30.
30.
What will be the interpretation of this? What will be the interpretation of this?
It's rather 5 points.
5 points. Okay. 5.22. Okay, the percentage doesn't matter. What is the interpretation of that? Let's look at the variable cost.
Sam,
Yeah.
yes, it means when the revenue is reduced by 5.22 percent, the project will break even.
Okay. That is nice. That is nice. Sometimes they can also ask you to calculate for the unit. You just find the present value of the unit. That is all. But mostly they will not ask you for the units. Okay. Let's come to variable cost. How do we do this? It will be the NPV divided by what? The net present value of the variable cost, isn't it? The variable cost is 33,000 every year times 3.605 times 100. What are we getting? 33,000 times 3.605. What are we getting at it down? 11285 divided by 11895. 8965 times 100. What are we getting? Can you guys hear me?
9.49.
9.49. Interpretation.
Okay, the project will break even when the variable cost increases by 9.49.
Okay, that's all. I thank God that you have gotten the trick now. Okay, for the discount rate, I said that if you are asked for the discount rate, you calculate the discounted payback period, subtract it from you calculate the internal rate of return, subtract it from the discount rate, divided by the discount rate, you multiply by 100. Okay, I don't want to. Let's come to the D part. Let's come to the D part. I say sales volume is our contribution. Take note of that. The sales pie is the same as the revenue, total revenue. Take note of that. Okay. Let's come to upon further investigation, it is found that there is a significant chance that the expected sales volume of 20,000 units per year will not be achieved. The sales manager of UMONAT Co suggests that the sales volume could depend on expected economic state that could be assigned the following probabilities. So this is about risk. The first question that we solve is about uncertainties. Okay, so the D part, they are now telling us that the figures that we use, the 20,000 that we use for every year will not be achieved, but rather they are giving us if the economy is poor, it is likely that the company is going to sell 30% of 17,500. So what will be the quantity that they will sell there? So we find the expected demand under each of the economic states, So we take the first one, which is poor. So poor is 0.3 times 17,500. How many units are we getting here? How many units are we getting there? How many units would they be selling if the economy is poor?
5250.
5250 units. Let's count to normal. What are they saying? How many? What will be the percentage? 0.6 times 20,000. How many units would they be selling in this?
12,000.
That will be 12,000. Okay, let's count to good. Good. We have 0.1 times 22,500. How many units would they be selling here? 2250. So the question now is, how many units are we going to be selling in all? If the economy is poor, we are selling 5250. If the economy is normal, we are selling 12,000. If the economy is good, we are selling 2,250. But we don't know whether it is going to be normal or it is going to be what? Poor. So what we do is that we make estimates for all of them. So it can be normal, poor, and this, we put all of them together. So plus 12,000 plus 22,500. So what are we getting?
1,950.
Is that Robert? Okay, 19,500. So this is the expected values. So it can be poor or normal or good. So if you want to undertake or add all of them together, so our NPV now will be this. Let's come to our revenue. So let's determine the cash flow under this. So our revenue for a year will now be 3 times 19,500. Okay, and our variable cost will now be 1.65 times 19,500. Everything will be like that. but just that it is only the demand that is going to change. 3 times 19,500, what are we getting? 58,500. And our variable cost, 1.65. 1.65 times 19,500. I'm getting 32175. Is that correct? Is that correct?
It's correct.
Okay. So what will be our contribution?
26325.
26325. Our fixed cost will still be the same. This question is only the demand that is changing. So our fixed cost will still be what? 10,000. Our cash flow every year will now be 325. So let's go and prepare our NPV. The question says you should calculate and comment on the NPV. So the NPV, you have the years, you have the cash flow, you have the discount factor of 12%, then you have the PV. The first year, 50,000. The discount factor will be 1.00. 1.00. Then we have 50,000. So year 1 to 5, our cash flow is now 16,325 times 3.605. What are we getting? 16,325 times 3. I'm getting 588 51.
Two. Or are you running it?
Okay. Okay, let's run it to 52. Okay. 52. So what will be our NPV now? 8852.
8852.
Okay. So you can see that the NPV has reduced as compared to what? The first one. So the comment will be based on expected values. The NPV has reduced by how much? The NPV has reduced by how much? 8852 minus 11285. The NPV has reduced by 2,433. Okay. So under the expected values, the NPV is now 8852 compare with what? Where we have the normal demand of what? 20,000 every year. Okay. That is about the expected values or the risks and uncertainty. They can also
So
give you.
can
Yeah.
it also be in percentage?
The-
That's 11,285 minus 8852 over.
Yeah, you can also find the percentage decrease. You can also find a percentage decrease. There is no problem with that.
Okay.
All right. They can also give you the expected values relating to selling price. Whatever will happen, if they can say the selling price, the percentage of the selling price being 60% of the selling price being 200, 30% of it being 250, and 10% of it being 300. What you do is find the percentage of them, find the expected value, and add all of them. If you add them, then that will give you your selling price now. So 0.6 times 200. Then the answer that you get, you put it there. 30% of this, the answer that you get, you put it there. 10% of it, the answer that you get, you put it there. Then you add all the answers now. That will give you the selling price per unit. That will give you the selling price per unit. They can also do the same thing for variable cost, fixed cost. You just have to find your probability on it and add all the expected values that you have gotten. All right, let's come to another issue, which is the company deciding whether to lease the machine or they should buy it themselves. So if you need a machine for a project, the company can decide to go and lease it, or they will decide to purchase the machine themselves. So if they want to lease or buy, what are the things that they are going to look at? You have to calculate the cost that the company is going to incur under the lease. If you are leasing, what is the cost that you are going to incur under leasing? And if you are buying outright, what is the cost that you are going to incur? The cost over here, we find the present value of all the costs that they are going to incur. So the lease can be operating lease or a finance lease. You see, if it's an operating lease, the risks and control associated with the asset will not be passed to the lessee. The lessee will only have a right of use. But anything that will happen to the asset, it is the lessor who is going to take care of it. So that is an operating lease. An operating lease, we don't have anything called depreciation because you are not the owner of the asset and you are not even having possession. The risks and everything associated with the assets are not transferred to you. But a situation where if there is any maintenance on the assets, if there is any insurance, it is the lessee that is going to bear the cost. We assume that lessee is the owner of the asset during the lease period. In that case, the lease will be classified as a finance lease. Okay, but mostly in the exam, the question that they will give to you will be an operating lease. Okay, if it is a finance lease, you see that the lessee will be paying a rental payment. The rental that you'll be paying every year, either in arrears or in advance. That particular amount that you are going to pay is tax deductible. You are going to enjoy tax benefit on it. So if you are paying 10%, you are paying 10 million every year. If you are paying 10 million every year, the tax rate is 25%. The meaning is that the amount that you are paying will be 0.75%. You are paying only 0.75% of this amount. Because the 10 million that you are going to pay, you are going to enjoy tax benefit on it. The tax benefit is 2.5. So in actual sense, you are paying only 7.5. Because the amount that you are paying is reducing your tax liability. The tax authority will allow that for tax purposes. But the manner in which the company is paying the rent tax, you have to pay attention to it. So if you come to the operating lease, the only thing that the company can enjoy is the capital allowance or the tax benefit on the rental payments. Okay, whenever you pay the rent tax, the tax authority will allow you to deduct it. So you are going to enjoy tax benefit on that. So the only cost that we incur under the finance lease is the rental payments. Then we subtract the tax benefit from it to get the net cost and now present value it. Okay, if you come to the outright purchase, what will happen is that all the things that you are going to enjoy, you are going to enjoy capital allowance, because if you buy the asset yourself, you are going to use it and the tax authority will give you a capital allowance. So you are going to enjoy the tax benefit on the capital allowance. If you also incur a maintenance cost on the asset, the tax authority will give you a capital allowance on the maintenance cost. The meaning is that they will allow you to subtract the maintenance cost from your profit before they charge their tax. So if you are buying the asset outright, you will enjoy capital allowance. You also enjoy capital allowance on the maintenance cost. Okay, those are the two things. If you come to a finance lease where the assets be seen as your own assets within the lease period, you are going to depreciate the lease assets. So what will happen is that whenever the company pays for the rentals, the company is going to enjoy capital allowance on the rentals. The company is going to enjoy capital allowance on the depreciation of the lease assets. The company is also going to enjoy capital allowance on the finance cost. You see that if you are doing finance lease, you are going to present value or your rentals that you are here to pay, which will be a lease liability. So at the end of every year, you calculate or you unwind the lease liability. You will now try to present value it. When you now try to what future value it, you'll be multiplying the discount rate. You'll be unwinding, charging interest on it. That interest will be, the tax authority will allow the company to subtract the interest from profits before they will charge what tax on the remaining profits. So that particular interest also will be allowable for tax purposes. So if you're using finance lease, you are going to enjoy capital allowance on the finance cost, which is the interest payment. You are going to enjoy capital allowance on the depreciation of the lease asset, and you're also going to enjoy capital allowance on the rentals or on the rental payment. Okay, but mostly the question will give you operating lease and outright purchase, because the finance lease, you have to do the calculation for the lease, for the lease liability, which is measured initially as the present value of the minimum lease payments. So since you are not financial reporting students, you are only financial management and management accounting student. They won't bother you with the finance list. They won't bother you with the finance list. They won't bother you with the finance list. So let's take question number. What is that question number? Question number, what's... Okay, let me talk about the discount rate that we use. The discount rate that we use is the borrowing rate. We use debt rate, cost of debt rate. Okay, what we are, the assumption is that the company is going to borrow the money and use it to buy the assets. So we don't use the cost of capital to present value the lease, the cost of the lease, and also the outright purchase cost. We assume that the company is going to take a loan and use the loan to what? To purchase the assets. So we use the cost of what? The borrowing. We use cost of borrowing, and the cost of borrowing that we use is always after tax cost of capital. But if the question did not say anything that it is after tax cost or it is before tax cost, if you are given a percentage like that, nothing is said, assume that it is before. So you have to find the after tax cost of capital. Let me look for this question. Then we try it and see. Okay, let's look at question number 29. Question number 29. Auntie Eunice, are you there? Auntie Eunice, are you there for me? Auntie Eunice, are you there? Robert, read for us.
Sir,
Robert, read for us.
please, I'm a bit, my attention is a bit divided. Please, if someone can take it up.
Your attention is what?
Okay.
I have a divided attention now, so please, someone should take it up.
Leave the
Sir,
class.
please, it's like you don't have the question.
Yes, the MA people you don't have.
Should I read?
That is the advantage of doing MA without FN. Let me share my one with you.
Should I read? Or
No, go through. Question number 29. Who is reading?
Lease or buy decision could be a tough call to make, especially considering that different industries benefit more than others from leasing or buying outright depending on the specific needs of the sector. there is a need to assess the pros and cons in relation to your own unique. Frida Automobile, an emerging automobile company, has taken a decision to provide a new Toyota Land Cruiser for its chief executive officer. The company is considering whether to buy or lease. The Toyota Land Cruiser has a useful life of 6 years and will cost 1 million Ghana cedi to buy and will be funded with a bank loan. The finance director provided the borrowing interest rate of the loan at 22% per annum. The annual repairs and maintenance cost of the V8 is is bought is 18,000. If bought is 18,000.
The annual
The
cost,
corporate
the annual maintenance
repairs and
cost
maintenance
when
cost
the V8 is bought. When the V8
bought,
is bought. Okay.
yeah,
When the V8
is
is bought.
18,000
Yeah.
per annum. The annual repairs and maintenance cost when the V8 is bought is 18,000 per annum. The corporate tax rate is currently 25%, paid in the same year the profit is made. The capital allowance on the V8 is 25% per annum on reducing balance method. Alternatively, the Toyota Land Cruiser could be leased at a rental cost of 250,000 per annum for 6 years, payable at the beginning of each year. Required. Explain 2 reasons why Frida would prefer leasing option to outright buy. Calculate the NPV for the buy option. Calculate the NPV for the lease option based on your computation in II and III. Above, advise management which option should be considered. That's the end of the question.
Okay. So if they don't give you lease or buy decision, could be a tough call. So they will, when people you won't know that this is Africa. Oh, no. So explain 2 reasons why Frida should consider leasing the asset. That is the first one. Why do you think a company will make a choice to either lease an asset or, okay, the question was, the focus is the company will lease the asset. What do you think will be some of the things that a company will consider before deciding whether they should lease an asset? Or
Okay, I will talk first of the first one to be cash flow. They will not be required to cough out 1 million Ghana cedis. So they think maybe 250,000 will be better comparing it to the outright purchase of 1 million Ghana cedis might affect their cash flow.
okay,
Oh.
that is fine.
They will not lock up capital in purchasing the asset at a go.
Okay. That will.
So during leasing, the automobile company or the company Freda is purchasing from is entitled to for repairs and maintenance of the assets, but not Freda.
Okay, so the maintenance costs and those things will be avoided, isn't it?
Yes, please.
Okay, that is fine. Is that all?
I want to ask if there will be tax savings or
Tax savings. At least if you are saving the tax, that will go in your favor.
So you rather use number because if you buy, you pay capital allowance tax.
Yeah, you enjoy. So if you are not buying, it means that the capital allowance that you are going to get on your tax savings will be lower than if you should buy, but the cost will be higher than if you don't buy. So the first one is to save cost. Okay, you see the
Okay.
maintenance cost of 18,000. The company is not going to incur that every year. Okay, and another one is it will also like you removing 1 million to go and buy an asset. No, that will affect your cash flow. That will affect your cash flow. That will affect your cash flow. And even after the asset is after you are going to use the asset for only 6 years. After the 6 years, what are you going to use the asset for again? After the 6 years, what are you going to use the asset for again? Okay, are you getting the argument? So after the 6 years, you're not going to use the asset for anything again. So the asset will be there. And maybe if people are not willing to buy the assets, what are you going to do? If people are not willing to buy the assets, what are you going to do? Okay, so that is also a problem. Okay, I want to share the answers with you. Can you see my screen?
Yeah.
Can you see question 4 something?
Yeah.
Okay. So reasons why leasing is preferred to buying. So leasing prevents higher initial cash outlay upfront compared to buying. It helps to reduce the risk of holding obsolete equipment since it's owned by the lessor, especially in fast-changing assets. Transfer the cost of maintenance to the lessor depending on the terms. Provide a better option to access and use assets or equipment if the company credit score is not good. Any other points acceptable. Any other point acceptable. So if you are going to fall in the any other point acceptable, so you can write anything there. But you can see that all that we have said, they are all in line with what they are saying here. Are we okay? All right. Okay, let's come back to the question itself. Let's come back to the question itself. Okay. So what we do is we ask ourselves, if we want to buy the asset, what is the cost that we are going to incur? And if you want to lease the asset, what is the cost that you are going to incur? Okay. The question is saying that calculate the net present value of the buyer option. So the buying option, what you do is you have your years 0, 1, 2, 3, 4, 5, 6. Okay. Then a year 0, we are going to have the initial investment, which is the cost. Year 0 will be the cost. So what is the cost of the asset? How much are we paying?
1 million.
Okay, this 1 million. So dash, 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 dash. Okay, then we are going to incur a maintenance cost, isn't it? Okay, maintenance cost, it will be how much every year?
18,000.
18,000. That is an outflow. 18,000. We are paying. So it's an outflow. It's a cost. Since it's a cost, you put it in brackets. So 18,000 every year. 18,000 every year. 18,000 every year. But what we have to do is that a company is going to enjoy what we call tax benefits or tax savings. So you have to calculate the tax savings. You have to calculate the tax savings. Okay. You have to calculate the tax savings. The tax savings will be on capital allowance and also the maintenance cost. The tax authority will give you capital allowance on the maintenance cost. So let's now count to our tax savings. Okay, last time I've shown you a table. So we have the years, we have our depreciation, or we have the cost. You have the cost here, you have your depreciation, then you have your tax benefits, your tax savings. Your tax savings will be calculated as a tax rate multiplied by the depreciation. So you can put them in brackets. and put them in brackets. Okay. What is year one? What is the cost of the assets? That will be 1 million. Am I correct?
Yes.
Okay. What is the depreciation rate? What is the depreciation rate? The capital allowance on the V8 is what? 25% per annum.
25.
Okay, so what will be the depreciation in the first year?
So first year, okay. Yeah, even it for 6 years.
250,000.
250,000. Okay.
Yes.
What will be the benefit what will be the tax benefit on the depreciation? What will be the tax benefits? Assuming you should pay tax on depreciation. Assuming you should pay tax. How much are you going to pay?
60,500.
60,500. So that is what we call the tax benefits. So the tax benefit is calculated as the tax rate multiplied by the depreciation. In the second year, they are telling you that the capital allowance is given on what? Reducing balance basis, isn't it? So second year, what will be the balance for the asset? What will be the balance on the asset? That will be 750,000.
750.
Okay. Then we calculate depreciation of 25% on that. What will be the depreciation? 187,500. What will be the tax savings on that?
46,875.
46,875. Okay. Let's come to year 3. What will be the figure that they will give the capital allowance on? That will be the carrying value minus the depreciation for that year. 560,500. What will be the depreciation? What will be the capital allowance on that?
1406.
140.
140,625. What is the tax benefit?
35,156.25.
Okay.
156.25.
So 35,156.25. So you can make it maybe two decimal places will be fine, or you can even approximate it to the nearest city. 351,351,56. That is all. Let's come to year 4. What will be the carrying value? So this one, let's just approximate this one like this.
431,875.
4,
31875.
4, 3,
421,875.
make it, do it small for me. I'm not like you.
1875.
4,275. What will be the depreciation?
105.
105,468.
469.
5468. Okay.
No, don't approximate this one. Approximate only the tax savings. So you can multiply this figure by the
Okay.
full amount times 0.25. So 26,367.
367.
Okay. So because if you approximate this one, the tax savings can also give you decimal. You are going to approximate again. So approximate only the final answer. What will be the carrying value for year 5?
Three one
31.
6464 06.25.
Okay. Capital allowance.
79
101.
0.56.
Tax savings.
19,775.
Okay. Year 6. What will be the the reducing balance for year 6.
Two, three,
2, 3,
7, 3,
3,
7,
7, 3,
3, 0,
7,
4.69,
7, 3, 0, 4 points.
69.
Okay. 0, 4.69. Okay. If you come to this side, pay attention. Pay attention to this side. Do we have any residual value in the for the assets?
no,
Okay. If you have any residual value, the residual value will be an outflow. It will be an inflow in the 6th year. Okay. Last time I said that the tax authority does not give capital allowance on the depreciation that the company is going to charge. They give the capital allowance on their own way, which is what we have done. So they will calculate the capital allowance on the initial cost, whether there is a residual value or not. But in the final year, which is the 6th year, the tax authority will subtract the residual value from this amount. The remaining portion, then they will now charge tax on all of them. Okay, if the asset is not going to have any alternative use, the question can say that the asset will be used elsewhere. The asset will be used elsewhere. If the question says the asset will be used elsewhere, it means that after the 6 years, the company will take the asset to a different place and start using it and be enjoying the capital allowance on that. So if the question says that the asset will be used elsewhere, the tax benefit for this year will be only the depreciation on this amount. So you have to depreciate this amount 25% and multiply by 25% if the asset will be used elsewhere. It means that if the company send the asset to elsewhere, they will still be enjoying the capital allowance on it. But the question says that the asset will not be used again after the useful life, which is the case here because nothing was said about that. Okay, if that is the case, then what you do is that if it has scrap value, take the scrap value from the final carrying value. Then you charge capital allowance on the full amount because the company is not going to use the asset. If they should use the asset elsewhere, the benefit that they will be enjoying, they will enjoy. But since they are not going to use it, the tax authority will give them capital allowance on the full amount here. So you are not going to charge depreciation here, but you calculate the 25% on the full amount here. That will give you the capital allowance, or that will give you the tax benefit. So let's multiply this figure by 23,730.69. What are you getting?
59,
59,326.
326.
Okay. This is a tax benefit on the capital allowance, but the maintenance cost will also be tax deductible. So you find the capital allowance on the maintenance cost too, the tax benefit on the maintenance cost. The maintenance cost is 18,000. So if you should pay tax, how much? It will be 25%. So what will be the tax benefit on that?
4,500.
Okay. So if you come to this one, your tax savings, you can do it capital allowance. So you bring the figures one by one. So the first one is what? 6,500. 6,500. This is a benefit. So it will be positive. If you come to your second, it is 4,6. 875. If you come to the third year, can someone pick these figures and mention it to us? 35156. Okay, fourth year. 226. 367. Okay.
100.
Okay.
It's around
19,775. Okay. Then we come to 59,326. Oh, is that 326? Okay. Then you come to tax benefit on the maintenance cost. That will be 4,500. 4,500, 4,500, 4,500, 4,500, 4,500. These are all benefits, so they have to be in. So you have your initial cost of 1 million here. Then let's add these items one by one. So you now have your discount factor. The discount factor, the 22 given to you over there, you assume that it is what? It is before tax. So you find after tax. So that will be 0.22 into bracket 1 minus 0.25. That will be your after tax discount rate. Let's find that. Let's find that. So you have 22 times,
2.5.
okay, 0 point, that is Adam, I don't trust you. So 16.5%, okay. Okay, I want to talk about something. You see, sometimes they will tell you that, you see, the corporate tax is currently 25%, pay in the same year the profit is made. Sometimes they can tell you that the corporate tax is paid 1 year in arrears. So in that case, the capital allowance should also be enjoyed in that manner. So it means that if the tax is paid 1 year in arrears, it means that the tax for the first year will be paid in the second year. So you also have to enjoy the tax benefit in that manner. So the tax benefit for first year will be second year in that manner. But this one, you are paying the tax in the year in which what profit is made, in which profit is made. So first year, the tax will be paid in the first year. Let's total this. 62,500, 62,500, 62,500 plus 4,500 minus 18,000. I'm getting 49,000. Is that correct?
Yes, correct.
Okay, the second year is what?
33,
33,
375,
375. Okay. The third year is what?
21656,
21656. Okay. Fourth year.
12867,
12867. Fifth year.
3275,
Is it?
6275,
62,
75,
6275. Okay. Last year.
45826,
826. Okay. Then you now come and put your discount factor here, 1.00. You find your discount factor for each of the years. Then you now find the present value. So your discount factor for the first year multiply by this, multiply by this, multiply by this, multiply by this, multiply by this. Then you now add all the cash flow. It's just the normal one that we do. So the discount factor for the first year, what are you going to have? 16.5%. What are you having? Discount factor, which is 16.5%. The first year is what?
Hello,
Yeah.
sir, please, how did you get the 16 contract? I didn't get that point. It went very fast. I didn't get that.
Okay. Let me see your name before I will mention the person that can help you. Okay. I want to see the person again. Please, can you talk again?
I'm Eddie now.
Yeah, Eddie now. Which of the Eddie now? If you're Eddie now, then your name should help you. Because whatever happened, God will see you through. Or your own is not like that. Okay. Robert. Robert. Adam.
Yeah.
Help your countrywoman. How did you
So they
get
said
it?
there was a tax, and then said we should assume that whenever there is the borrowing cost, the interest rate we should assume it is before tax. So you have to less the 25% tax from the 22%. So 22 minus into bracket 1 minus 22 into bracket 1 minus 0.25.
Okay, so the Edinam, I hope you are using your calculator. You are punching your calculator at once.
Yes, please. Yes.
Okay.
So this is the new
Okay.
after tax interest rate. So that's what we use for the discount factor.
Adam,
Okay.
I didn't say
Yeah.
that
Thank you very much.
I should assume. I said that whenever nothing is said about the borrowing rates, sometimes they can tell
Oh,
you that
okay.
after tax cost of borrowing, it means that they have already taken into consideration tax. But if nothing is
Okay.
said about it, then you should assume that it is what? Before.
Before, okay.
Someone can also take the 22 like that. No, there is nothing. Because since if it is after or before, you should say it. Since you don't say it, it means that I can take the 22 as the what? The discount rate. But don't go and use cost of capital. We use cost of debt. If they give you a
Okay.
discount rate, don't use it because we assume that the company is going to borrow the funds
Borrow the fund. Okay.
from a bank and use it to purchase the assets. So the discount factor for the first year, I'm getting 0.858. 0.858. Okay, am I correct?
Yeah, that's correct.
Okay.
Yeah.
Second year will be what?
0.737.
0.737. Okay. 0.632.
Correct. 632.
Fourth year.
Confirm. 0.543.
0.543. 543. Fifth year.
0.468.
468. Last year.
0.4. Correct.
0.400. Okay. So what you do now is you just what? Discount this cash flow. You can see that these are all positive, isn't it? Okay. These are all positive. So if you get the figures over here, you have to subtract it from this one to get the net cost. This will not give you a positive answer because this is cost. There is no revenue here. So this is purely cost. So the first one will still give you your 1 million, which is the cost. So let's count to the first year, 49,000 multiplied by 0.858.
434. 42042.
Okay, 42042.
042.
Okay. Let's count to year 2. So if you can get this cash flow to multiply them one by one.
245.
24597.
97.
Okay, let's count to year 3.
1368.
13686.
686.
Okay. Year 4.
5387.
Okay.
13687.
13687. Okay. Year 4. 6987 like this.
Yeah.
Okay. Year 4. Year 5 rather.
2924.
2924. Okay. Last year.
18330.
18. 330. So what you do now is these are all positive cash flows. So add them and subtract it from this. The figure that you are going to get will be the net present value of the cost. Then you put it there. Then you now come to your lease. You count your lease option. The lease option, what you do is you also put the years here. 0, 1, 2, 3, 4, 5, 6. So you look at the rent tax. The first payment will be the rent tax. How is the rentals paid? They will give you how the rentals will be paid. It can be paid in advance or in arrears. So how are they paying the rentals? Alternatively, the Toyota Land Cruiser could be leased at a rental cost of what? 250,000 per annum for 6 years, payable at the beginning of what?
Every year.
Okay. At the beginning of year 1 means what?
We are paying the 250 outright. So
And I'm saying
January.
that at the beginning of year 1 means what? If you are doing MPV, investment appraisal, at the beginning of year 1 is the same as what?
Year 0.
Year 0.
Ending.
So that will be the beginning of the year 0. So every year you are paying 250,000. This is every year. This is yearly rent tax. So every year you pay 250. Every year you pay 250. 6 times. So you finish paying at the end of year 5. So year 6, you won't pay anything. Okay. Then what you do is you also enjoy tax savings on these amounts. Okay. The tax savings, you are going to enjoy the tax in the first year. So you are going to pay the tax at the end of the first year. So the tax savings will come at the end of the first year. So you will not start enjoying the tax in year 0. No. Tax will not be paid at the beginning of the year. You pay tax on profit at the end of the year. So the tax benefits will come in year 1. The question is, the tax authority will allow you to deduct this for your profit before they will charge tax. So what is the tax benefit that you are enjoying on this? So it will be the tax rate multiplied by the rental payment every year. So how much will be the tax benefit every year? How much is the tax benefit every year? I'm getting 62,500.
62,500.
Okay, 62,500. 62,500. 62,500. 62,500. 62,500. So let's now look at our net cash flow. This will be 250,000. What will be the difference between these ones? This will also be 62,500. So 250,000 minus 62,500. What are we getting? 187,500. So this will be negative. This will all be negative. 187,500. 187,500. 187,500. Negative. 187,500. Okay. So what you do is you now use the discount factor here to discount them too. So you discount them to find the net present value of the cost. So the first year will be 1.0. This and this, you use it to multiply. Then you now add all the costs there. You now add the cost. So the cost that you are going to get over here, you compare with the cost that you are going to get under the MPV. So the one with the lowest cost is the one that you go for, because this is cost, not revenue. So what is the cost under the MPV? What is the
Under the buying option, the
Yeah.
MPV under the buying option will be 891,433.
891,433.
33.
This is the net cost. So if you come to the lease option, you multiply your net cash flows by the discount factor. put all the costs together. You have to know that this is inflow, this is revenue. So that this one you're going to get over here should be subtracted from the cost. You put them together, compare with this. This is cost. So which of them that is lower? That is the option that you go. So multiply it because I don't have a space here. I did workings here. So multiply that. Then you give me what you are going to be getting. The last thing that we want to talk about is asset replacement. Asset replacement policy. Okay. Asset replacement policy. Okay. The asset replacement policy, what we are basically coming to look at is that, you see, a company, sometimes company will acquire an asset, which they will make decision as to when they should replace the asset and when they should not replace the asset. So if you have a car or if a company has a computer, the question is, when should we replace our computer? When should we know that the computer is old? And when should we replace it so that our cost will be minimized? So the company has to decide where they should replace their assets, when they should replace their assets. This one we use two methods, but the most common one that we are going to look at is what we call the analyzed or annualized method or something. I've forgotten the actual name, but it is the annualized replacement method, or there is a name like that. I've forgotten the name of the, but that is what we do. Okay. Under the annualized replace, we also have the LCM. The LCM is where we try to make the useful life the same. We try to make the useful life the same, but we're not going to talk about that. We're going to talk about the annualized one. So the annualized one, what we do is that we find the NPV over the annuity factor of the NPV. So you can see that this is how we find it. So we find the NPV of the asset, the number of years that we want to replace the asset. What is the NPV divided by the annuity factor of the years that we are taking into consideration? You can see that the sensitivity analysis depends on NPV. Lease or buy depends on NPV. Asset replacement policy depends on NPV. Internal rate of return depends on NPV. Discounted payback period depends on NPV. NPV is very important if you come to investment appraisal. All right. So the question is, we calculate the replacement, or we determine when we should replace the asset by doing what we call the annualized method, which is the NPV of the years that we are replacing the asset divided by the annuity factor of the years that we are replacing the asset. So in that case, let's take question number 5. It's very simple. Let's take question number 5. Let's take question number 5. Adam, read for us. Question number 5.
Okay, question 5. TS operates a fleet of vehicles and is considering whether to replace the vehicles on a 1, 2, or 3-year cycle. Each vehicle costs 25,000 Ghana cedis. The operating cost per vehicle for each year and the resale value at the end of each year are as follows. So year 1, 2, 3, and then we have operating costs, resale value, and the values are there. Okay. So the cost of capital is 6% per annum. You should assume that the initial investment is incurred at the beginning of year 1, and that all other cash flows arise at the end of the year. What is the equivalent annual cost of replacing the vehicles every 2 years?
Forget about every 2 years. We do for every year. The question will ask you to find the appropriate replacement period for the assets. So we do as if they are not asking us to calculate when the asset should be replaced. Okay, I want to say this. You see, under NPV, all the questions that we are solving, we assume that the initial cost will be paid immediately, isn't it?
Yeah.
Okay. There can be a question that they will tell you that the initial investment, the initial cost will be paid in a year's time, or will be paid at the beginning of what? Or will be paid at the end of year 1. In that case, you are not going to have year 0 again. The initial investment will now come under year 1. But we assume that will always be paid at the beginning of the project. Sometimes you can pay you can buy the asset on credit and pay a year time. So that a year time, we need to find the present value of that. In that case, the initial investment will come under year 1. So if you read the question, I don't know whether you are reading the question. If you read the question very well, I have a question. I know I have a question among this where they are telling you that all costs will be incurred at the end of year 1, including the initial cost. I know I have a question like that. But I can maybe I'll read through and see. Okay, but before that, let's look at this. So what we do is that we say the annualized method is the NPV over the annuity factor. So the question is, we assume that we are replacing the assets every year. So if you are replacing the asset every year, which is every 1 year, okay, what you do is you calculate the NPV years, you calculate your cash flow, you put your discount factor here, then you put your NPV. The discount factor is 6%. So the first thing is we have year 0, which will be our initial amount that we are paying for the asset. What is the initial amount? So our initial amount is 25,000. So this is what? 1.0. So we have 25,000. Okay. We assume that we are replacing the assets every 1 year, every year. Okay. So in the year 1, we are going to incur operating cost of what?
Sir,
Yeah.
this is a question. The latter part of the question says that you should assume that the initial investment is incurred at the beginning of year 1, and that all other cash flows arise at the end of the year. Isn't it what you were talking about, similar to what you were explaining, that if they don't say something of this nature, the initial investment has to appear under year 0. But this one, I think the question was saying, assume that the initial investment is incurred at the beginning of year 1.
Okay.
Does that suggest that the initial investment will be under year 0?
Okay, are you done?
Yes, please.
Laugh at yourself.
Rob, I'm laughing at you.
Okay. Adam, at the beginning
Yes,
of year
sir.
1 means what?
1st January.
Which is the same as what?
The
31st
previous year, 31st December.
Which is the same as what?
Annuity
December.
deal.
Which is year 0. At the beginning of year 1, we assume that all cash flows arise at the end of the year. So if they say at the beginning of year 1 is now, which is the same as 0. Because there is no ending, which is the same as 0. So that's why I say you should laugh at yourself.
So if it is at the end of year 1, then that would have been the beginning of year 1, right? It will start from year 1. But beginning is still year 0.
Okay. Or you're asking a
I say,
question?
yes, I'm asking a question.
No, I can't see question mark at the end of
The
it.
only thing that is making, or the only thing that will push the initial investment to year one is that if the beginning was rather changed to end of year one. That's my question. Or if they say end to year one, but still it will be year one. It will be year zero.
At the end of year one, and you are starting a project today.
At the end, so it will be 31st of that year one, 31st December of that year one. So which is
Hello, sir.
Yeah.
Yes, I was thinking that when there is a constant cash flow, and they said it's at the beginning of the year, then in other way we may consider it as an annuity deal.
It doesn't matter.
So
Even okay, annuity due. Okay. Annuity due. Okay, let's move on. Okay.
yeah, so with an annuity deal, we always have to begin from the year zero.
Okay.
Yes.
So you want to know why? This one is not
No,
constant
it was
cash flow.
a suggestion I was making.
No, this is not constant cash flow. This is the initial amount. It's an amount that you are going to pay once and for all, which is the initial investment at the beginning of year one. But if you have issue with annuity due, where the cash flow is constant, what you do is that the first cash flow, you are not going to discount it because it will be under year zero, which is the same as if it is 5,000, the 5,000 is the same as the today's value because you are getting the money today. So that is the today's value of that particular amount. The present value, what we are coming to look at is what is the today's value of the amount that you are telling me I'm going to receive in 3 years' time. What is the today's value? That is what we present value it. So if you are dealing with annuity due, okay, all the questions that we have dealt with are all ordinary annuity, where we are assuming the cash flows are at the beginning of the year. But if you are dealing with annuity due, the first cash flow will not be what? Present value, because that will be under year zero. So the discount factor will still be 1. But the subsequent cash flows will be what? Will be present value using the appropriate discount factor. Okay, we haven't taken any question like that, but it is nice that you have opened my mind to that particular side. But the 25,000 over here is not an annuity. It's just an amount that you are going to pay for the asset. It's an amount that you are going to pay to acquire the asset. If you want to pay for the asset, we are going to pay today and take the asset today. So the money that you'll be giving to the person today, if you take it to the market, it will still be the same amount. So if you give me 25,000 today to acquire the asset, today's value of the 25,000 is the same as what? 25,000. I'm not going to receive the 25,000 in a year's time. I'm going to receive it today. So the present value of the 25,000 is the same as the present value is the same as the 25,000 because I'm going to receive the money today. So at the beginning of year one is year zero. At the beginning of year two is the end of year one. Take note of this. All right. Let's come to the every year. Come to the every year there. Every year for the year one, what are you going to do? You are going to incur operating costs of what? Year one, you are going to incur operating costs of what?
5,000.
And at the end, you sell the vehicle for what?
18,000.
So what is the net amount are you getting?
12,000.
You'll be getting what?
18,000.
You're right. The net amount will be 13,000. You are going to sell the assets for 18,000, but you have incurred a cost of 5,000 rather, not 15,000. So in actual sense, your net proceeds will be 13,000. Don't come and do year one, 5,000 as a cost. Year one, 18,000 as a cost. Since they are all going to arise at the end of the same year, just net your cost against your what? your revenue and bring the net figure there. Okay. So if you count the operating cost is 5,000, that will be incurred at the end of the year. And at the end of the year, we sell the asset for what? 18,000. So in actual sense, we are going to settle the 5,000 out of the 18,000 and now be left with what? 13,000. So the 13,000, the discount factor for the first year, which we are going to use for the 13,000, will be 1 divided by 1.06. I'm getting
0.943.
943. So what will be the present value in that regard?
What? 12,259. 12,259.
12,259.
9.
So what will be the NPV?
12,741.
12,741. So if you are replacing the asset every year, this is the cost that you are going to incur. The NPV, we say the NPV, which is 12,741 divided by the annuity factor of so this is only 1 year. So the annuity factor is 0.943. How much are you getting?
One, 3, 5,
13511. Okay, this is the cost. Let's count to every 2 years. You are replacing the asset every 2 years. Okay, in each case, you are going to buy the asset first. So you have your 0, which will be 25,000. Before you replace, you have to buy. The discount factor will be 1.00. Then we have 25,000. Okay, let's count to year 1. If you are replacing the asset for every 2 years, it means that you are going to use it for year 1, isn't it?
Yeah.
So if you use it for year 1, what are you going to do? You are going to incur the operating cost of what? 5,000. Are we okay there? Are we okay with that side? You are going to incur operating cost of 5,000 for year 1 because you are going to use the asset for year 1. It will be at the end of the second year that you are going to replace it. So you incur the operating cost of 5,000. So you present value it, and that will give you, what will be the present value there? 5,000.
Since it is 6%,
So 4,000.
we got 4,715.
Okay.
Hello, Doc.
Yeah, senior. Yeah, senior, I can hear you.
Doc, can
Yeah.
you take the 5,000 again?
Okay, the 5,000, what we are saying is that.
Can you take the 5,000 again? Okay.
Okay, the 5,000, what we are saying is that you are going to buy the assets. You are going to buy the asset at the beginning of year 1, but you want to replace the assets at the end of the second year. So at the end of the second year, it means that you are going to use the asset for the first year. So if you use the asset for first year, you are going to incur an operating cost of 5,000. The operating cost can be a maintenance cost or anything. So you are going to incur that particular cost for the first year, whether you like it or not, because you are going to use the asset for the full first year. So operating cost of 5,000 will be incurred. Okay. But if you come to year 2, what will be the operating cost in year 2? What is the operating cost in year 2? It's 8,000. Okay.
7,000.
At the end of year 2, we are also selling the asset for what?
15,000.
So what will be the net proceeds there?
7,000.
So what will be the discount factor?
0.890.
0.890 or 7.
0.
Okay. So let's find the present value there. What are you going to have?
6,230.
6230.
0.
Okay. 6230. This will be inflow. So let's add it to get our net present value. So
23,485.
23,485. So let's find our cost of replacing, annualized cost of replacing the asset. It will be 23,485 divided by the annuity factor for 6% for 2 years. The annuity factor have to be the number of years that you want to replace the assets. So we want to replace it every 2 years. So what will be the annuity factor for the 2 years? The annuity factor is the summation of this. So if we add these two, that is the annuity factor. Or if you like, you can also find the annuity factor for 6% 2 years. That will give you the same thing. So let's add the two. 0.0943 plus 0.890. I'm getting 1.833. So let's find the cost of replacing the asset every 2 years. What are you getting? 23,485 divided by 1.833. I'm getting 1, 2,
812.
okay, 812. So this is the cost of replacing the asset every 2 years. Let's count to every 3 years. The last one, every 3 years. So every 3 years. So we have our years here, our cash flow, our discount factor, and our present value. Whether you like it or not, you buy the asset for every year. You buy the asset before you think of replacing it. So you always buy the asset. But in year 1, you are going to incur operating cost of what? 5,000, whether you like it or not. 0.983. So that operating cost, this one you just beat it up. So this will be the same as 4,715. It will be a cost. Year 2, what will be the operating cost that you are going to incur in year 2?
7,000.
The operating cost?
8,000.
8,000. You can only enjoy the residual value when you want to sell the asset. So year 2, we don't want to sell the asset. Year 1, we are not going to get the resale value because we are not selling. You can only get the resale value or the residual value when you decide to sell the asset. So since we want to replace the asset at the end of every 3 years, it means that the resale value for year 1, we are not going to get it because we are not selling in year 1. But the operating cost, we are going to use the asset for that year. So we are going to incur the operating cost, whether we like it or not. Okay. You only get the resale value or the residual value or the scrap value when you are selling the asset. So if you come here, this will also be a cost, whether we like it or not. We use the asset for the full year, second year. So what are we going to get for 7120? That will also be a cost. Let's count to year 3. Year 3, what is the operating cost?
11,000.
And how much are we selling the assets?
5,000.
So what will be the net amount?
2,000.
A lot of 6,000.
That will be a cost of 6,000. What will be the discount factor for the third year? 0.840. Okay. What will be the present value there?
5040.
5040. So what will be the total present value here?
$31795 negative.
Hey, I'm getting 41875.
41875.
They are all negative. The third year is not positive.
No, the third year.
It's not. It's
Oh,
negative.
yes.
The third year we are.
Yaboka.
Okay. So let's count to analyze cost of replacing this. That will be 41875 divided by the annuity factor. The annuity factor is the summation of all this. Or you can find the annuity factor yourself. Okay. You can find the annuity factor yourself. So what will be the annuity factor there?
2.673.
2.673. How much are we getting?
15665.
15666.
Kilometers.
Okay. So the question now is, let's count. If we want to replace the assets every year, what is the cost? Is 13511. Every 2 years is what? 12812. Every 3 years is this. So what will be the optimal replacement policy?
Year one
Are you
should be
serious?
replaced every year
Are you sure?
because it gives the
No.
lowest. Year two, sorry, it gives 12,800. The
Okay.
lowest.
So we replace the asset every 2 years, because that is giving you the lowest cost. So this is all about the replacement one, but we use two methods, the SCM, and we use the analyzed replacement method or analyzed cost method. Okay, but I would like us to use the analyzed one. But what we have to know is that since the introduction of the new syllabus, asset replacement policy is yet to be examined. Sensitivity analysis is also yet. Payback period in FM is also yet. But mostly they examine the MPV and other ones. The lease or buy also was examined, but you just learn everything. So I'll put some questions together on the investment appraisal. Okay, let me.
Doc.
Yeah.
So in exams, they will not limit you to a particular method. They will make it open so that you use what you want to use.
No. Mostly they will ask you for the analyzed one.
Okay. Thank you.
I want to talk about what we call capital rationing. Last time we talked about profitability index, and we also solved question on profitability index. Profitability index is where the entity wants to undertake a lot of projects. So you have 200,000 million, or you have 200 million, but you are considering a lot of investments. So you don't know how you are going to combine the investments. So you have 5 investments. How do you combine them? You don't know how you are going to do the combination. So the profitability index help us to do the combination. So you find the profitability index to now rank the projects in accordance of their profitability index. We solve a question in MA on that. And the profitability index is calculated as the present value of the initial investment. The initial investment is of the specific project. So you take the project A. What is the specific investment for that? Take their net present value or their present value divided by their initial investment. The answer that you get, you put it there. You rank all of them using their PV, their present value, over the initial investment, or it can be calculated as the NPV over the initial investment plus 1 or plus 1. So you take the NPV for each of the projects divided by their initial outlay or their initial investment. The answer that you get, you put it there. So the one with the highest profitability index, that is what you are going to pick. Okay. And I also went ahead to say that sometimes they can say 2 projects are mutually exclusive. 2 projects are mutually exclusive. The meaning is that you can't undertake the 2 projects at the same time. So if they say that project A and B are mutually exclusive, the meaning is that if you undertake A, you cannot undertake what? B. That is mutually exclusive. If you undertake B, you cannot undertake A. The 2 cannot happen at the same time. Okay. The question can also say the 2 projects are independent. It means that you can undertake the 2 at the same time. You can undertake both A and B at the same time. That is independent. Okay. The question can also say that the projects are dependent. The meaning is that you can't undertake one without the other. So you either ignore the 2 or you undertake the two. It means that the project A depends on the project B, or the project B depends on the project A. So since you are undertaking project A, you have to undertake the project B too. You don't have any option. That is dependent project. You either undertake the two or ignore the two. Okay. The question can also say the project is divisible. Okay. These terms are associated with what? Profitability index. In whichever way you are going to calculate the NPV of the two of all the projects. Then they can say the projects are divisible. So if you rank the project A, B, C, D, E, and you have undertaken A and B, C, the money that you have used is 170. You have only 200 million. Okay. The remaining amount left is 30 million. But you want to undertake project E. Project E is the fourth one. According to the profitability index, is the fourth one. But the project E is demanding 70 million. If they say project E is divisible, it means that you can use some amount of money on it. If you don't have all the 70 million, the amount that you have, you can put it there. So in this case, you can put the 30 million there. You can just put a certain amount of money into it because it is divisible. You can share it. But if they say the project is indivisible, it means that you can't invest part in it. So if you don't have all the 70 million, don't undertake the E. You can decide to go and put this money elsewhere and get small amount on it because the project E is indivisible. Indivisible means you either get the full amount required or you leave the project. Divisible means if you don't get a full amount, any amount that you get, put it there. That is the issue about that. But what I want to talk about is what we call capital rationing. Capital rationing. Capital rationing is where a company has a limited amount of money to invest, and investment has to be compared in order to allocate monies most effectively. That is the same as the profitability index. You have a lot of investment, but you don't have the necessary funds to do that. Okay. So the issue can be you want to do your masters and you want to do CA at the same time. You don't have the money. So you just have to make a choice between any of them. How do you make that choice? You have to look at the one that will give you the best return. So you choose. But if you should have money, you should have just gone ahead and carry out the two at once. So the company will be having a lot of investment. They don't have the fund. So what they will do is that they have to use the profitability index to now apportion the funds to them. So we have two types of capital rationing, which is called internal factors, which you also call the soft capital rationing. The soft capital rationing. The internal has to do with issues coming from inside. The company don't want to go for debt, or the company don't want to issue additional capital. They don't want to use their equity to finance the project, or they don't want to use their reserves. Okay, so the inability of the company to raise more funds for the project internally is what we call the soft or the internal factors. Okay, so the company don't want to have or issue debentures, issue shares for the project. So what we'll do is that we can't afford to get or raise additional money for that. Let's use the money that we have. Okay, that is the internal or the soft capital rationing. Okay, that one is happening internally. So the company can solve it. The company can decide to issue the shares or issue the debentures. Okay, the external has to do with something that is outside the firm. The company don't have any control on it. So the Bank of Ghana can give what? Can give notice that they should not, or banks should not give what? Additional funds, or they should not borrow, or they should not lend money to what? Companies. The government of Ghana can also say any company that want to undertake this project, no bank should grant them what? Credit facilities. Okay, so that is about the external, which we call the hard capital rationing. This one happened externally. Okay, the external stakeholders refusing the company funds, especially the bank. The bank will look at your statement of financial position and say that no, we cannot give you additional funds. And that one, you can't do anything about it. So for the hard capital rationing, there's nothing that the company can do about it. You don't have control over it. But for the internal, you have a kind of control over that. All right. So they can ask you, in theory, you should be able to explain that. You should be able to explain that. Okay. On this note, the MA people, okay, we want to say thank you for coming. The FM people, what I want to say is that as time goes on, the institute is also raising the standard of the exams. If you look at some of the questions from the time that the new syllabus was introduced, you will tell yourself, oh, I should have written FM this time. But from the last 3 sittings or the last 2 sittings, you can see that the standard of the question has changed. And the only way that you can be able to make it is to practice, solve more questions. Because the more you solve questions, the more that understanding will come. There is no way you solve 1 question, 2 questions, and you say that you know this topic. No. You go and see a different thing and you don't know what to do. And that was what happened at the beginning of the class, question 14. Someone's problem was something that me, I'm not even thinking about. Meanwhile, the real problem is there. Okay, so I cannot write the exam for you. I cannot write the exam for you. So you should try your best. The questions are plenty. You are even lucky that I have about 30 something questions for you. I haven't even finished solving 5. And they will ask you right now, you say you are done with investment appraisal. Which part of the investment appraisal are you done with? So, you will have to know that if you pass, that will be a plus on your report card. And if you fail to, that will also be a minus on your report card. It will not affect me anyway. It will not affect me anyway. So let's try our best. Let's try our best. The questions are plenty here. Let's try our best. So we are done with the investment appraisal. Tomorrow or Saturday, I will share financial risk management notes with you, and we'll use Sunday and Thursday to finish that. If you don't have any question, it's 9:17. I would like to stop here and we'll continue on Sunday. Thank you.